Welcome to the deep dive. Today, we're getting into the latest numbers from HDB Financial Services Limited.
That's right. They're unaudited standalone financial results for the quarter ended June 30, 2025.
Exactly. And our mission, as always, is to look beyond just the headline figures. We want to unpack what's really going on.
We'll be drawing on their official filings, press releases, the investor presentation.
And that recent earnings call, too. Basically, give you the key insights without you having to sift through everything yourself. A shortcut to understanding this, well, major player in India's financial scene.
And it's especially important with HDB. They just had their IPO on June 30th.
Right, listed July 2nd. So these are their first results as a listed company.
Precisely. So understanding the why behind the numbers is crucial. And interestingly, the board meeting to approve these results, it was long.
How long?
Started at 11:10 a.m., finished at 4:50 p.m. on July 15th. That tells you there was probably a lot to discuss.
Definitely suggests some serious deliberation. Okay, so let's start with the basics. Who exactly is HDB Financial Services?
Well, fundamentally, they're an NBFC, a non-deposit-taking, non-banking finance company. And a big one, a subsidiary of HDFC Bank.
And the RBI has a specific classification for them, doesn't it?
They do. Upper layer NBFC.
Yeah.
That basically means the RBI sees them as systemically important, comes with tighter regulations, but also reflects their scale.
Okay. And stability-wise? Credit ratings?
Top-notch. CARE AAA and CRISIL AAA for long-term debt and bank facilities.
That's as good as it gets.
Pretty much.
Yeah.
And A+ for their short-term stuff like commercial papers. So very solid footing there.
Now, you mentioned their market position is unique. They talk about aspirational India. What does that mean in practice?
It means they're really focused on customers who are often, let's say, underbanked or underserved by the traditional banking system.
So lower to middle income households, maybe limited credit history.
Exactly that. People often starting their credit journey. And their reach is, frankly, incredible.
How so?
They've got 1,771 branches across 1,166 cities and towns. And here's the key part. Over 80% of those branches are outside India's top 20 largest cities.
So deep penetration into smaller towns, semi-urban, maybe even rural areas.
That's their whole strategy. It's about being present where others might not be.
Okay, incredible reach. So how does that translate into their actual business? What are the main things they lend for?
They have three main business verticals. First is enterprise lending. That started back in 2008.
And that's a big chunk.
Yeah, it's about 39% of their gross loan book. It offers secured and unsecured loans, mostly for growth or working capital needs, to individuals and businesses.
Okay, 39%. What else?
Next up is asset finance, started in 2010. That's another big piece, 38% of the book.
Asset finance, so vehicles, equipment.
Precisely. Financing new and used commercial vehicles, trucks, buses, construction equipment, tractors. They often work closely with manufacturers, OEMs, and dealers on this.
Makes sense. And the third vertical?
That's consumer finance. Started more recently in 2016. It makes up the remaining 23%.
And this covers?
Things like two-wheelers, consumer durables, fridges, ACs, digital products, sometimes cars, other sort of lifestyle purchases.
Got it. Enterprise, asset, and consumer. So looking at the whole loan book then, it sounds incredibly spread out.
It really is. They serve 20.1 million customers.
Huge number.
But the average ticket size is only about Rs 164,000.
That's quite small, relatively speaking.
It is. And it means their risk is highly diversified. Get this. The top 20 largest borrowers, they only account for about 0.32% of the total gross loans.
So no concentration risk there. It's very granular.
Highly granular. Well-seasoned across different economic cycles, too. And importantly, 73% of that entire loan book is secured.
Okay, that 73% secured figure is pretty crucial, isn't it? Especially given their focus on customers who might be perceived as higher risk.
Absolutely. It provides a significant buffer. It means they aren't just relying on unsecured personal loans. There's collateral behind a large part of their lending.
Right. So we've got a picture of HDB, big NBFC, subsidiary of HDFC Bank, AAA rated, huge reach into aspirational India, diversified, mostly secured loan book.
That sums it up well.
Okay, so the big question, how did they actually do in this first quarter as a listed company? Let's get into the Q1 FY26 financials. What are the headline numbers telling us?
The top line looks pretty healthy. Assets under management, AUM, reached 109,690 crore.
Okay, how's the growth there?
That's up 14.7% year-on-year. Solid. Total gross loans are very close to that. Euro 9,342 crore, growing 14.3% year-on-year, and also 2.3% just since the last quarter.
Decent momentum. And net interest income, NII.
NII came in strong at 2,092 crore. That's an impressive 18.3% jump year-on-year and up 6.0% quarter-on-quarter.
Wow, 18.3% II growth is quite something. Net total income.
That also grew 14.2% year-on-year, reaching at 2,726 crore. So good top-line growth across the board.
Okay, strong growth, especially that NII figure. Now, what about margins? With interest rates generally trending down, how did their net interest margin, the NII, hold up?
Well, this is interesting. Their NIM actually expanded. It went up to 7.7% in Q1 FY26.
Expanded, really? From what?
It was 7.6% in the previous quarter, Q4 FY25, and also 7.6% in the same quarter last year, Q1 FY25.
So they managed to increase margins despite falling rates. How?
Management pointed to a recalibration of their product mix, basically shifting focus slightly toward higher-yielding products within their existing verticals. It shows some strategic agility.
That is agile, and you're saying the benefit of lower rates on their own borrowing hasn't fully kicked in yet?
Exactly. They expect the full impact of lower system rates to filter through in the coming quarters as they replace older, more expensive debt. So potentially more tailwinds for NIM later.
Interesting. Okay, NII and NIM look positive. How does that flow down to the bottom line? Profitability.
Profit before tax, PBT, was 733 crore for the quarter.
And after tax, PEEK.
PT stood at 568 crore. And their pre-provisioning operating profit, PPOP, also showed healthy growth, up 17.2% year-on-year to a 5-year 402 crore.
Okay. Now, return metrics like ROA and ROE. We need to factor in the IPO proceeds here, right?
Yes, that's important context. These returns are calculated after accounting for the 2,500 crore they raised in the primary part of the IPO.
So what was the return on assets, ROA?
It came in at 1.94%. But they also mentioned if you adjust for the OFS part of the IPO, about 9,000 crore that didn't come into the company, the ROA would look more like 2.02%.
Okay, a slight nuance there. And return on equity, ROE.
ROE stood at 13.16% on an annualized basis. Earnings per share, EPS, was 7.1, and book value per share ended the quarter at 225.4.
Right. So strong growth, expanding NIMs, decent profitability. But now we get to the part that, well, might raise some eyebrows. Asset quality.
Yes, this is where the picture gets a bit more complex.
What are the numbers showing for gross stage 3 loans? That's basically their NPAs, right?
Correct. Gross stage 3 increased to 2.56% as of June 30th.
Okay, up from what?
It was 2.26% at the end of March and 1.93% a year ago in June 2024, so a noticeable rise.
And net stage 3, after provisions.
That was 1.11%, up from 0.77% a year ago.
And the provisioning coverage itself?
That dipped slightly. Provisioning coverage on Stage 3 assets was 56.70%, down from 60.24% a year prior.
Okay, so higher NPAs, slightly lower coverage. What about the actual cost of those provisions, the credit cost?
Credit cost for the quarter was 670 crore. That's a pretty significant jump from the 412 crore they booked in Q1 of the previous financial year.
Right, that's a big increase. So higher bad loans, higher costs to cover them. What did management say was driving this deterioration?
They pointed mainly to weakness in the commercial vehicle, or CV, segment within their asset finance vertical.
Okay, the trucks and buses financing.
Yes. And also, to a lesser extent, some stress in unsecured business loans within enterprise lending.
Any other factors mentioned?
They did mention Q1 is often seasonally weaker for vehicle finance anyway. And interestingly, they cited unseasonal rains.
Rains. How did that impact things?
Apparently, it affected sales of compressor products, think ACs, refrigerators, which dampened some activity in their consumer finance vertical, though that wasn't the main driver of NPAs.
Okay. And on the CV side, any specific reasons given for the stress there?
They noted vehicle prices have gone up quite a bit, partly due to new technology requirements, like mandatory AC cabins.
Ah, right.
This means, according to them, vehicles are maybe being used for longer periods before replacement, which can impact the cycle. They also said they're actively reorienting their product mix strategy within CVs.
Reorienting, like shifting focus within the CV space.
Seems like it. And they suggested the strategic shift is already starting to help their NIMs, as we discussed earlier.
Okay, so connecting the dots there. But for you, the listener, what's the takeaway? We see stress, but what's the outlook?
Well, management expressed confidence on the earnings call. They said the current credit costs are largely in line with expectations.
So not a surprise to them internally.
Apparently not entirely, and they expect things to stabilize through Q2 and then improve going forward. They sounded particularly optimistic about the CV segment improving as the broader economy picks up.
Okay, cautious optimism for management. And this is backed by their risk management framework, presumably.
Yes, they emphasize that. They have a dedicated chief risk officer board-level risk committee oversight.
Right.
And that hybrid underwriting model, automated for small loans, physical checks for larger ones, plus a big in-house collections team.
How big?
Over 12,500 employees just in collections. They use multiple scorecards, geotagging, and crucially, over 95% of collections happen via banking channels, not cash.
That's a robust process. Okay, so we see the asset quality challenge, but also the management's response and underlying systems. Now, what about new business generation, disbursements?
Right, the flow of new loans.
Mhm.
Disbursements in Q1 FY26 were 15,171 crore.
And how does that compare?
It was actually down
Yeah.
14.0% compared to the previous quarter, Q4 FY25, and down 8.1% compared to Q1 last year.
A slowdown in new loans. Where was that felt most?
Most pronounced in that same asset finance vertical, down 15% year-on-year.
The CV segment again?
Likely related, yes, and also some slowdown in enterprise lending, specifically in those unsecured business loans.
Did they say why they pulled back there?
Yes, they stated they had consciously slowed down unsecured business lending a couple of quarters back already. They're kind of watching the economy before pushing harder there again.
So a deliberate pullback in certain areas. What about consumer finance disbursements?
That segment held up better, although the average ticket size was slightly lower this quarter.
Because of those compressor products affected by the weather?
Exactly. But aside from that, management said consumer finance is performing quite well overall, both in terms of growth and asset quality, so diversification helps cushion the blow.
It does. Okay, let's switch to the other side of the balance sheet. Funding. How are they financing all this lending?
Their funding mix is quite well diversified. As of June 30th, it was roughly 39% from non-convertible debentures, NCDs. Another 39% from bank loans.
Yeah.
And the rest is a mix of commercial paper, CPs, external commercial borrowings, ECBs, and some perpetual and subordinated debt.
And within those bank loans, is there anything important about the interest rate linkage?
Yes, very important. Over 90%, actually 95% of their bank borrowings are linked to the external benchmark lending rate, or EBLR.
And why does that matter now?
It means as market interest rates fall, their cost of borrowing on that large chunk of debt should automatically reprice downwards relatively quickly.
Ah, so that should help their margins, their NIM, in the coming quarters.
Precisely. It's a built-in benefit that should start feeding through, supporting profitability.
Got it. Okay, moving on to efficiency.
Yeah.
How are they managing their operating costs? Cost-to-income ratio.
That actually showed some improvement. The cost to income for the lending business was 42.7% in Q1.
Down from
42.9% in Q4 FY25 and 43.2% a year ago in Q1 FY25. So a positive trend, suggesting they're keeping a lid on costs despite their granular branch-heavy model.
Now, you mentioned earlier their ROA might seem a bit lower than some other NBFCs. Is that purely down to this granular model?
That's largely the management's perspective, yes. They argue that serving millions of small-ticket customers across thousands of branches inherently has a different cost structure than, say, a wholesale lender doing large corporate deals.
So it's a strategic trade-off. Lower ROA maybe, but wider reach and diversification.
That seems to be the rationale. And they do expect ROA to improve as those credit costs hopefully moderate and the NIM benefits from lower funding costs kick in.
Makes sense. And their overall capital strength, are they well cushioned?
Very much so. Total capital to risk-weighted assets ratio, CRR, was strong at 20.18%.
Well above the regulatory minimum.
Comfortably above.
Yeah.
Their debt-to-equity ratio was 5.15, and their asset liability management, ALM, looks solid too.
How so?
They have a positive cumulative mismatch across all time buckets, meaning their assets are generally longer term than their liabilities, which reduces liquidity risk. Their liquidity coverage ratio, LCR, was also very healthy at 151%.
So strong capital, good liquidity management, overseen by
An ALCO, their asset liability committee, which keeps a close eye on liquidity risk, interest rate risk, and any currency risk. Standard practice, but seems robustly implemented.
Okay, so beyond the core financials, which paint a picture of, let's say, managed growth facing some headwinds, what about the underlying strengths? Technology seems key for them.
Absolutely. They lean heavily on tech. It helps speed up loan onboarding, improve underwriting using data analytics, and makes collections faster and safer.
And they have that mobile app, right? HDB on the go?
Yeah, and it's apparently surpassed 10 million downloads already. That's significant engagement, especially for reaching customers in Tier 2, Tier 3 cities and beyond.
And risk management isn't just about credit risk, is it?
No, it's broader. They talk about diversification across products, customer types, geography as a risk mitigator. They also have a specific operational risk management committee.
What about tech risks themselves, cybersecurity?
Yep. They mentioned having a cyber resilience framework and a business continuity management, or BCM, plan. Essential stuff nowadays to make sure systems stay up and running securely.
Right. Now, ESG, environmental social governance, is a big topic everywhere. How does HDB stack up?
They seem quite active. They have a board-approved ESG risk management policy.
Any concrete examples?
Well, their corporate office got an IGBC Gold certification for being a green building. They do reforestation drives, handle e-waste management, water conservation projects.
So, environmental initiatives, what about the SNG social and governance?
On the social side, their CSR efforts are quite extensive. They claim to have impacted over 1.5 million lives via 100-plus projects.
Like what kind of projects?
Tree planting over 500,000 trees, they say restoring lakes, plus work in healthcare, education, skill development. On governance, they highlight diversity, over 23% women in their workforce.
And the board composition?
Strong independence there.
Oh.
7 out of their 9 directors are independent. That's generally seen as good governance practice.
Okay, so summing it all up then, what are the key takeaways from this deep dive into HDB's Q1 FY26 results?
Well, we've seen a company that's still growing its loan book and NII quite strongly.
But facing definite challenges on the asset quality front, particularly in CVs and some unsecured loans.
Right. They seem to be navigating that actively, making strategic shifts in lending focus, like pulling back slightly on disbursements in certain areas while seeing resilience elsewhere, like consumer finance.
And their model remains very much rooted in that granular, retail, aspirational India focus.
Exactly. Backed by significant investments in technology, a diversified funding base that should benefit from falling rates, and what appears to be a robust approach to risk and compliance.
Plus that stated commitment to ESG and CSR.
Yes. So it's a picture of controlled growth managing specific segment stress with several underlying strengths.
Which brings us to a final thought for you, our listener. Considering HDB's deep reach into aspirational India and their reliance on very granular localized assessment.
It really makes you wonder, doesn't it? In today's financial world, where credit quality can swing with economic changes, how might a model like HDB's influence financial inclusion more broadly?
Right. And what does that focus on the underbanked, combined with their scale and tech, actually mean for the long-term resilience and sustainability of their own business?
It's something worth pondering as you look at these results and watch how they perform in the quarters ahead. Could their approach be a kind of template for growth in these vital market segments?